If you haven't figured it out by now, you're in the Larry Williams part of the presentation. And I'd like to talk to you about a lot of things. We're just going to kind of bounce all over the place for a while today, and then we're going to end up at the end of the session with some absolute commodity entry signals, rules, systems, the whole thing, so you have something you can take home with you. And not only that, I'm going to give you a trade for Monday. I figured you might be interested in having that, right? So this afternoon I've been whirling through the computer with the System Writer program, looking to see if there's any buy signals. And as George and a couple of my other followers know, there's buy signals for Monday. And we'll be talking about that as well, so I'll show you what that trade is. But I want to talk about something that's been real near and dear to my heart for a long time. Because when I first got in the market, one of the first areas that I started to look at, I thought maybe this could predict the future. Ooh, wouldn't that be nice, with cycles. And gee, back in the 60s, that was a big deal. There were all sorts of cyclical analysis. There was a Foundation for the Study of Cycles. There was a Society for the Investigation of Recurring Events, which is where I met W.D. Gann's son. And it was intriguing to see and to go to these meetings and talk about cycles with people and see that none of the cycles ever really worked out in real time. They were close, but the problem with the cycle was this. And I'd like to show you what I think we can identify that problem as being, is that given the market, cyclical analysis says something like this should take place. We should be a buyer here and a seller here. And that's really nice, but what is the scale on our chart? Does anybody know? What's the scale down here? Time, right. And the one up here is dollars. Now, let me ask, which one does the banker accept? Have you ever gone to the bank and said, I'd like to give you 24 days? So, what? You're crazy. This is the important thing, because what I've noticed happen in cycles is the market comes down like this. Sure enough, it kind of stops for a while, and then it comes down like this. But we cyclical players bought in here, and the market didn't have a magnitude to it. It didn't have a price move. It had a time move, if you will. But only all too often, cyclical analysis, my experience was, simply didn't deal with the magnitude. So you were there, you'd bought because of a 28-day low or a 362-year low or high or whatever, and you waited another 363 years to get the end of the cycle, and it never developed. It was only a time phenomena. So I decided I've got to get involved with a price phenomena as opposed to the time phenomena. And while people were looking at the cycle in terms of time and low points in the market, I started to see something else. And I'd like to talk a lot about that today, because I'm going to reveal to you what I think is the absolute true cycle of the market. And I don't know why it took me so long to see this, and why we missed this for so many years. But this is, in fact, the way the markets work. I'm going to show you the two cycles, and I don't care if the time frame is 5 minutes, 5 hours, 5 days, a week, a month, a year. What you're going to see is the way the markets really and truly work. And this cycle both of these cycles are wonderful because you can build trading systems with them. The first cycle that I'm going to point out to you is a cycle of ranges. If you were to simply take the daily ranges without the trend in the market, you would see that the ranges go something like this. Because we have a baseline here, and you would notice that the market cycles from large ranges to small ranges to large ranges to small ranges. In other words, the range for the week has been very small for a couple of 3 weeks. Then it gets very big for a couple of 3 weeks, and it gets very small for a couple of 3 weeks. And the same thing takes place with daily charts. You'll have small ranges, and after you've had a series of small ranges, lo and behold, you get big ranges. Now that's phenomenal. Because how do we make money in trading commodities? What do we need? What is the basic thing that we need, other than a lot of luck? We need large ranges, right? Without large ranges, you're stuck in the mud. You want to be stuck in the mud? I'm going to give you the secret to being stuck in the mud. Start trading after large ranges. But what pulls the public in? What gets us all excited about a market? You got it, large ranges. And then we say, I'm bored with this market, because it's not doing anything now. And then you see a large range market like coffee or something, and you get over there, and then it goes in the mud of small ranges, and you're stuck in the mud again. So one of the most important and dominant cycles in the market that I can share with you is you've got to be watching for the range size, and you want to be getting into the market when the ranges have been small. That's the cycle you can make money with. Forget this time cycle, 28 days or 97 hours or whatever. I'm more concerned about the range cycle, because you'll see the market. I don't care what chart you look at. You've got a book there with 900 and some pages in it. You pick out any chart you want at any time you want, and you'll see what I've shown exists. Absolute, it's always there. Small ranges to large ranges. So you might want to build a trading system. In fact, earlier today I thought, I try to get a point to really prove this. I ran some stupid little system, the S&Ps, that basically said we're going to buy a 6-day breakout, the highest high of the last 6 days, and sell the lowest of the last 6 days. If the range of the last 3 days is larger than the previous 3, and the system didn't work, in fact, it lost money, a lot of money, and then I said, okay, now we're going to do the same entry rule, same exit rule, except we'll put in the criteria that the last ranges for the last 3 days must be smaller than the previous 3 days, and lo and behold, it made money. And I think this is a wonderful little tool you can add to any of the systems or your own trading strategies, is where are you within this cycle of the ranges. For in our range, but it did gap from the previous night's close. So you really need to take into consideration these gaps to measure the cycle of the size of the range. And once you start to do that, you'll say, oh yeah, we're set up for a move now. Clearly, I haven't told you which way it's going to move, up or down, though. That's the problem. All that you know is that you're established, the market has set itself up to move and get into a large range situation, which is where we're going to make our money. Question here? No. Okay. So that is one of the dominant cycles that you need to really incorporate in your work. That's a real cycle. And the neat thing about it is to look at any marketplace, any time, and you'll see that it's there. It's always there. It's universal. So I would say let's start working with that one. And I'm going to give you some ways we can work with that, but I want to talk with you a little bit about the next phase of that cycle first. It's an interesting phase. Now, we can start to fine-tune that a little bit. I'm going to show you a couple of things here at the same time. One is how you really make your money as a short-term trader. And then I'm going to give you an idea of buyers and sellers in the marketplace so you can measure accumulation and distribution and get a sense of what the market's really doing. There is a pattern to the way the market trades. And again, this is universal. We've just learned large range days, small range days. Now I'm going to give you the other pattern. There are really two aspects of this cyclical phenomenon on a short-term or longer-term basis, and it's this. Large range days most always close on their highs. That's really interesting. Large range days most always close on their highs. If the market's moving around like this, it's in a small range situation, and then it has a large range day, not always, because not always isn't a term that's known in the commodity market, but most of the time the close will be right around the area of the high. Now this tells us lots and lots of things, a lot of information we can use here. First of all, it tells us that as a short-term day trader, so if there's any day traders left alive in the world, or a short-term trader, that you don't want to try to buy here and get out here, buy here and get out here, because you're stuck in the mud. I don't want you stuck in the mud. I want you running down, with an open field. So where we're going to make our money as short-term traders is to buy in here someplace and hope we get into a large range phenomena day, and we're going to get out on the close or maybe sometime tomorrow. Of course, the opposite, and I'll get into the opposite. That's the nice thing about my stuff. Like I said, I'm a pretty simple guy. There it is. So a large range day, I don't want to take a 75-point or 100-point profit in the S&Ps. I'm going to sit there and meditate and concentrate and pray that I got a large range day. And then I'll get out at that close or sometime later on. And these big wins from the large range days will pay off the little days where I didn't get a large range day, where I got in, lost some money, made, scratch, commission, whatever. But since I'm not going to start trading, I'm not interested in trading until I've had small range days, my odds of getting into a large range day have been enhanced. I still may not get it today, but eventually I'm going to get a large range day because I've isolated, okay, we're in this part of the cyclical part of the range phenomena, and now we're just waiting for one of these large range days. And it's so tempting because, especially if you've had a couple losing trades and suddenly you got 200 points in the S&Ps or you got 16 ticks in the bonds, and you just want to say, I'm getting out of this thing. This is great. I haven't seen a profit for a while. Don't. You want to hold till the end of the day or as long as you possibly can, and you're going to pick up a lot of money that most day traders are leaving right there on the table. So large range days, you want to hold as long as you possibly can. Another interesting aspect of this that Ralph Vince taught me, and he's one of the most brilliant minds that I've ever worked with in the marketplace. I'll tell you another secret about large range days. Large range days don't work both sides of the opening very often. I'm going to explain that for you. Some of you might not even be aware of the opening price. In my book, the opening price is clearly the most important piece of information you can work with. The market opens in the morning, and traders try to buy it, try to sell it, and then the market does what it's going to do. But it'll work around that opening price until some consensus develops, and then it'll go wherever it's going to go. So I want to watch not yesterday's close, but I want to watch this morning's opening and see where we go from today's opening. That's the critical value or critical price point. One thing Ralph pointed out to me, he said, Larry, look at this. He said, large range days hardly ever move down very much from the opening. I said, gee, I think that's right, Ralph. And sure enough, went in and checked in the computer and looked at charts, and it doesn't take a rocket scientist to figure this one out. You look at any chart, and again, it doesn't matter what market, what time period, whether it's weekly, monthly, daily. This is the truism of the marketplace. Large range days open, they dribble down a little bit, and then they go boom, up, or they go down. They don't work both sides of the opening, 250 points in the S&Ps, and then get a large range day very often. Can it happen? Sure, it can happen. You'll work both sides and then go. But most large range days simply open and they're gone. You know what they do? They let the horses out of the corral, and you can't catch them. That's the way large range days really and truly trade. And it's interesting because what happens is the public keeps trying to buy all day long below the market, and they never get filled. And the short sellers keep selling all the way up in the rally, thinking it's going to pull back down to the opening. And so they got to bail out of their short sales later on in the day, which adds more fuel to the fire. So something you might want to incorporate in your short-term trading is some type of a question, the one that Ralph Vince postulated about what are we doing on both sides of that opening. If we worked a lot on one side of the opening, we're probably not going to go in the other direction if we have a large range day. So that's something that I found very helpful. And to know that when large range days occur, I just want to hold my breath, close my eyes, and hold on to this thing and see where it goes, because you don't know where it goes. Some of the easiest money I made in my life is doing just that, and leaving, walking away from the market, coming back at the end of the close and seeing the S&P is up 800 or 900 points. And let me tell you, when you're long 150 contracts, it feels wonderful, and you're real glad that you held, because you wanted to get out all the way along the line. If you start looking at all these 1-minute charts, 5-minute charts, I had a friend who had a system with 1-minute charts. He said, boy, this is a great system, but I'm not making money. I said, well, what's the problem? He said, well, by the time I pick up my phone and dial my broker, the 1-minute thing has changed. So, hey, get speed dial. He tried that. That didn't work either. You get so much data so close to the market, it always brings you off track. I don't know if anybody in this room has ever gone hunting. Have you ever gone hunting? Or maybe you're walking out in the woods and you see a mother bird and she's going like this, that wing is flapping away, and the hunter, the fox, goes after the mother bird, and all she's doing is protecting her little chicks, right? And then she flies away and you can't catch her. And I think of that phenomenon in the marketplace a lot. It gives us this little broken wing trick to try to get us out of our positions. And what you need to do is just say, I'm in this thing, and I'm holding on for hell or high water. And I think that's better than trying to figure out the machinations of every single tick in the marketplace, because I tell you, I can't do it. And I haven't seen many people that can consistently do it either. So I think if you're in a position to hold on to it. There was a question in here someplace. Yes?
How much would you risk on something like that?
How much would I risk?
Well, how many points would you risk in the S&Ps?
Well, in the S&Ps, I'll get into some systems that I'll teach you today on the S&Ps. Like I said last night, I don't like to sleep solidly through the night. I'm willing to risk some things. So my average risk on the S&P is more substantial than most people. It's about $2,200 per contract. Well, I wouldn't be a day trader, if you held a gun to my head. Well, it would probably be less risky to have somebody hold a gun to my head than be a day trader, as a matter of fact. I like to place my order, buy or sell it, place my stop, and then walk away from it. The classic story about Larry Williams, Jake Bernstein and I did a real-time trading seminar in Fort Lauderdale. And people paid a lot of money to watch us. We taught them for 2 days, and we traded real money for a day. And I placed all my orders, and I got filled. And my philosophy is I'm going to get out sometime the next day. Placed all those orders, and I said, well, I'm going to go out to the pool and lay in the sun for a while. I just walked out of the room. And so he said, well, we paid a lot of money to watch you trade and to learn something here. I said, yep. He said, oh, right. It depends on your trading style. Some people want to be there, but I'm an old guy, and I'm not as quick as I used to be when I was a kid. It's like, I don't want to be in front of a screen for every tick. I've done that. I've played that game. Been there, done that. And it's not my cup of tea anymore. It's a real strenuous game, incidentally. I hope that answers your question. Okay, now, so we know we go large range, small range to large range, and then we might get large range for a couple of days, maybe something like that. We open up here, and then, of course, after large ranges, then we're going to start to get small ranges. But now there's a third thing I want to show. As I go along, if you have questions, please feel free to hold up your hands also and ask any question that you want to. If there's anything I go over too quickly or I don't go into enough depth, please feel free to do that.
You're talking about true range or actual range?
Good question. The question, you're talking about true ranges or actual ranges, and let me explain that. How many don't know what a true range is? Could you raise your hand if you don't know what the term true range is? Okay, great. That's a real important question. The market may have closed here yesterday and opens here and closes there. Now notice that there's a gap in price between here. Really, the market closed here, so it kind of squiggled up there, didn't it? It just doesn't show on your chart because of the gap. So the true low is really right here, yesterday's close. The true low in this business is actually a margin call. But we need to take this into consideration because you may have a situation such as this developed. This is a wonderful situation. Let's say you're long this market and it limits up. What do you have? The high, the low, and the close are the same. You got a little tiny range, it looks like, if you use just the chart, high, low, close. But if you use the true low, then you're going to pick up a range like that, aren't you? So you need to use the true lows and the true highs. Coming down the other side of that equation would look like a market that does something like this. And you've got to account for this gap situation by saying, this is the true high. Simple statement. The true high will be whichever is greater, yesterday's close or today's quote high. And I'll reverse that. The true low will be whichever is lower, today's quote low or yesterday's close.
So on some days you're using the close to come up with that range, or is it every day?
On some days you will use the close as a substitute for the true low or true high, and some days you won't. Here's the days. Of course, if today's low is greater than yesterday's close, you got it, right? And on the high, if it's less than yesterday's high, you got to use yesterday's high. If it's greater than yesterday's high, you're going to use the chart. This would be the quote high. Got it? And that's real important for a lot of stuff in technical analysis. My work shows that about 15% of market activity's got gaps in it, especially in the currencies, and even more so now because what do we have that we've never had before? Overnight sessions, right? They're trading this stuff all around the world, so by the time it opens up here, there's a big gap in the market that isn't accounted for about the ranges. And again, it's a truism. I don't care what the market is. You pick out any chart you want out of your chart book, and what I'm going to divulge to you now is there. Any chart, anytime. Go back to 1932, 1988, 1888, and you're going to see this phenomenon. the market moves, I'm going to exaggerate. Everything I'm teaching you or showing you is an over-exaggeration, but you'll get the gist of it. Okay, we know we have large range days, small range days. This is the even more interesting phenomena, is where the close is within relationship to the range tells us where we are within the cycle. Watch this one. At market lows, we generally close right on the low or thereabouts. And as the market starts to come up, a really interesting phenomena begins to happen, something like this. And then the same thing happens in reverse. That's about the way the market moves. And again, this is a bit of an over-exaggeration just to make the point. But at market lows, there's very little close to low activity. These people that were buying that day, there's very few of them. That makes sense, doesn't it? Not everybody can make money in this business. And the informed money, if you will, are these guys that bought right there. The informed money on the sell side is the guy who sold at the high up there. That's what I wish the exchange would give us, the phone number of these guys that bought on this day. But you'll notice this phenomena continues to exist in all charts of all freely traded markets, stocks as well as commodities. It's even more apparent in commodities. So we can then say, well, gee, let's do this. Let's start to look at the buyers and see where the close is in relationship to the range to see where we are within the terms of the grand cycle or the where we are. Because basically what's happening, if you think about it, and you probably have already figured this out, is the public, we the people, somebody is getting more bullish, more bullish, more bullish, very bullish. See, markets don't top because of an influx of sellers. That's the conventional thinking. Oh, everybody comes in and sells and the market tops out. No, it tops out because there's an absence of buyers. And the proof of that is what you'll see in your charts. Now that you understand the kind of the X-ray view of the market, you'll see, yeah, the market's closing right on its high. It wasn't that there weren't any buyers around. Had all the buyers you could get. In fact, there weren't any more buyers. Then the sellers can start to have some influence in the marketplace. So we can put a formula here together that shows the relationship of these ranges and the closes, and I think we can probably develop a sentiment indicator. I want to touch on that. Last night I mentioned a little bit about sentiment indicators. Now you look at some of the work, the best predictive work that I know of in the stock market has always involved sentiment. Whether it's a specialist, the informed minority, or the floor traders, or whether it's the public, the odd lot short sellers, that's so predictive of the market. It doesn't do it to the day, but in terms of giving you a general idea, yeah, the market's in a high risk or low risk area. Investor sentiment is one of the finest indicators you can get, and precious little has been done about it in the commodity market. There's a CIBIT Hat-a-Day index, sentiment index, which is in some chart books. It's a real good tool to work with. Jake Bernstein does a fantastic thing where he calls up, 100 traders, 50 traders every day and asks them, are you bullish or bearish? And you monitor that data and you'll see that, when everybody's bullish, the market usually starts to come down. Jake had a major ethical problem. He had one guy who was calling every day who never was correct on the market ever. And in fact, he was a client of Jake's in a brokerage firm. And the guy only had losing trades. He never had winning trades. So Jake says, hey, I'm just going to do the opposite and make a lot of money. So if people are trading just doing the opposite, making a lot of money, and this guy runs out of money. So now, what do? You fund this guy? I don't know what the correct answer to that question is, but I mean, that is a truism that happens in the marketplace. So if we can follow the public in some fashion, and I'm going to give you a formula that will enable us to do this, to know when we're in this zone, with something that I put together called the Williams Sentiment Index, you're going to see that we can predict the highs and lows of the market pretty well. I'll give you an example right here. This happens to be some commodity. I don't even know what the commodity is. Gold. And the sentiment index gets into this area, and we're in the overbought area. It dips down here, and we get in the oversold area. Basically, my experience is that when we get greater than 65% bullishness, we're in the area of a top as we were here. And when we get below about 40 or 30%, really, I like about 30, 35%, we're in the area of some type of a short-term low formation as we were here, as we were here. In the book, I think you'll see that we've got the S&Ps from 1982 forward, I put in the book. So you can follow a long time period and get a handle, if you will, on how that market's reacted to this index. And I'll give you the formula for this in a little bit as well. Here's the sentiment index on the S&Ps. Notice what happens when we get above 65%. We start to get pullbacks. We're in a strong uptrend here. We're right at the highs of the market. Again, you're at this high. Over here, you're right in this high. And over here, you were in this high. And when you get into the lows down here, where there's basically this is measuring again this low to close relationship. There's not very much low to close activity. You're getting into the area of a low. And the formula for that, I've written, if I can recall this correctly, I'll give you the formula. We're going to take the close minus low, true low, and that's the next equation is the true high minus true low times 100. And this is a 9-day average, 9 days and 9 days. So I'm going to take so you can visually see this, the close minus the low, and I'm going to take the last X number of days. 9 days is a pretty good number. And then I'm going to take all of the true ranges for the last 9 days. And then I'm going to divide, we'll call this A, and we'll call this B. I'm going to divide A by B at times 100 will give me the percentage that you see on this chart. And you'll suddenly be able to see very clearly, without having to actually access 2,000 investors, a pretty good idea, an approximation of whether the market has had too many buyers or whether it's had too many sellers. After I developed this index, I put it in something called super charts, and just turned on a couple commodities and had my 10-year-old daughter come in the room. I said, "Hey, Paige, let me see if you can learn anything about commodities." I said, "Here's this little line down here. Do you see any relationship?" She says, "Yeah, Dad, when it's low you buy, when it's high you sell." Pretty simple. But you'll see that's just about what happens. You might want to incorporate a couple of little things in there, but basically when you get this index above 65%, you're close to some type of a market high. And when it's low, it's that under 40% area, you're at a market low. And I've tested this back now on just all the active commodities, and they put it in TradeStation in the other room, so on a break you can go back and look at TradeStation, and I've got it in my computer as well. You can pull up any market we want, and we can take a look at it, and you'll see that it'll give you a pretty good idea, an approximation of the public bullishness or bearishness to the marketplace. And when everybody's bullish, got to go in the other direction. When everybody's bearish, got to go in the other direction. Any questions on the sentiment index?
It works on all time frames?
I think it works on all time frames. I've only worked it on the daily data, but I don't know why it wouldn't work on other time frames. I would suggest another neat thing you can do about this, and for some of you who aren't interested in this, but in other market indicators and oscillators and things, notice I'm using a 9-day here because I trade the S&Ps, and that's most S&P moves are about 9-10 days. If you use a longer-term number, let's say we used a 20-day measurement. We did this for the last 20 days instead of 9 days. We would just get more significant overextended areas of the marketplace, very, very bullish or very, very bearish. So many people say, "Well, I'm using a 3-day moving average." Well, with a 3-day moving average, you know what you get? You get a day-and-a-half move. That's what you really figure out in the market. You get half the time frame. So some people will use a 7-day moving average, and you're going to just be able to trade a 3.5-day move in the marketplace. I mean, stop and think about it. If you're using a 10-day moving average, can you catch a 6-month move? Can't, can you? The length of the time period you're measuring is the length of the time period you should trade for. And it's always perplexed me that people will say, well, I want my average length of trade to be 25, 30 days, and they're using a 10-day moving average or a 9-day moving average or something. It doesn't compute. You have to use data that fits the time period that you want to trade for. Question?
What's your current rate?
I'm sorry?
What's the current sentiment?
What is the what?
Your current sentiment?
The current sentiment, we'll have to look at it. It's back there it had recently got into a buy area. Right at this recent high before the Dow and everything collapsed, it was way up high, like 62, 65%, and sure enough, then down comes the market. Now, the way you use this, you can't just take this on its own. I don't think you can take anything just on its own. Say, okay, when I'm above 65%, now I can take a sell signal that you wouldn't take at some other point. And when you're in the 35, 40% area, you can take a buy signal that you wouldn't take at another point in the marketplace. You might want to get one a lot closer. I don't know if you've seen Joseph Stowell's presentation. I haven't seen it, but he uses something he calls a naked range or clear range day or something that we've always called an overextension day. And basically it's something like this. If the market closes lower than yesterday's low, it's usually a pretty good buy at this day's high. Well, that's true sometimes, and sometimes it isn't true. It's more true as a buy if the sentiment index is below 35%, because you really, you're where you should be bottoming, right? And the same thing, just reverse it. If you're looking for a sell, if you're way up at a 65, 70% reading and you close greater than the previous day's high, and then you come down and take out this day's low, those are really good sells within this time frame. Too much investor bullishness or too much investor bearishness. Question? Okay. I talked last night about sample size, and I want to review that just briefly because a lot of people will be watching this tape that weren't there last night, and that wasn't a taped event. I'd just like to say about sample size that you've got to be real careful. I don't think there's any magic to just having 30 samples. That doesn't mean that it necessarily will hold up in the future. One sample may be enough if there's some underlying basis to it. Ayn Rand always said, check your premise. And if there's a premise to why you should be correct, maybe one example is right. The example I gave last night is that if you walk out of your house and a dog comes out of a gray house and bites you, you probably don't need to walk out of your house and in front of that gray house 29 more times before you develop a conclusion that house and that dog may have some tie-in there. So if there's some premise to your thinking about the market, I don't know that you need a large sample size, and I've seen large sample size things fall apart and not hold up in the future. So sample size, another interesting point to me has always been, and you'll see what I'm going to get into next, a lot of the stuff I'm going to show you next is highly specific to the S&Ps. No way is this stuff going to work trading orange juice or potato chip futures or whatever. It ain't going to work. And people will criticize my work saying it should be universal and apply to all markets at all times. And my reply to that is, maybe, but not necessarily. Again, if there's a premise to why this should work uniquely to this market, if there is, then I'm going to take advantage of that and use this in that market. As an example, the case of Treasury bonds. If Treasury bonds are in a sharp up rally and the S&Ps decline for a couple of days, are probably a real good buy. But the fact bonds are in a strong up move does not necessarily mean that oats are a good buy, or that the Swiss francs are a good buy. For a matter, it might mean the exact opposite, in fact. So I don't know that the parameters of a system must be universal and work in all markets all the time. It doesn't bother me to develop things that work in just a couple markets I trade. So enough of that, and we've got that point covered. So now let's talk about some actual things we can do trading. We've got, about another hour to go? How are we doing time-wise? An hour? Okay, good. I think I want to talk, first of all, about something called OOPS, which is one of the things that is probably I'm most known for within technical circles. What I'm going to show you is a great little entry technique, and I'm going to use this entry technique to teach you about the market tomorrow. Because I see a couple people starting to get tired and dozing off in this big dark room here, so I'll wake you up, and not for tomorrow, but for Monday, with an actual trade that we can take. So let me show you that. My OOPS system has been around a long time. This is maybe my 15th year of using it. And it's basically this. Really, one of the most simple techniques you'll ever learn about the market. If the market, regardless of where it closes, if it opens lower than the previous day's low, like that, and then rallies up, I'm going to be a buyer. Got it? It's got to open lower than the previous day's low, and then if it rallies back to the previous day's low, I'll be a buyer. A sell, you got a sell figured out already, I'll bet, don't you? There it is. You got it. Just the exact opposite, the reverse. That's all there is to it. That's oops. We're going to be looking at a buy signal in oops. And that's with an exclamation mark. Okay, now, I noticed something about oops, maybe 3 years ago. First of all, I made a lot of money trading oops, a tremendous amount of money trading this particular pattern. And I started to see that some days were better than others. There's a book, maybe some of you women have read it, called Some Men Are More Perfect Than Others. I don't know what that's about. I guess being more kind to women. But I started to think that the markets are that way too. Some days are better days than others. And so I did an interesting test. I ran through and said, what did you buy on the opening of Monday and get out on the close of Monday? The opening of Tuesday and get out on the close of Tuesday. Did that for every day, and like, whoa! Look at the information that popped up. Really, really interesting. And now I see there's quite a few other guys who've joined the bandwagon and say, yeah, Larry's got a phenomenon there we can take advantage of in the marketplace. I'll boil it all down to this. Mondays tend to be good buy days. Thursdays and Fridays tend to be good sell days. That's an oversimplification, but by and large, it's real true. In fact, the oops trades on Monday, I think there have been now maybe 97 oops trades on Monday. And as I recall, 89 or 90 of them have been winners. But oops trades on other days of the week have not been as successful, and the average length of the average profit per trade is real high, et cetera, et cetera, et cetera. So I did another test and said, okay, we're going to take an oops trade on a Monday, but the bonds must be in an uptrend. And that was real good. Well, really good. Oh, that's nice. But what do we know now on October 1st about the marketplace? Are bonds in an uptrend now? They're not, are they? We closed today pretty close to the lows of the S&P. Did you notice that? Those of you, does anybody here trade the S&P, or am I in the wrong room? We got any S&P? We do have some S&P traders. Good. Okay. So I know there's a good shot that I might open lower on Monday. I then went in the computer this afternoon and said, if we open lower on a Monday and bonds are in a downtrend, then is this any good or not? And someplace I wrote down the specific numbers, and I'll get them for you. And it's not bad. Someplace in... here we go. Can't find it. Well, the notes will appear here someplace magically shortly. But as I recall, there have been 9 oops trades when the bonds have been in a downtrend, such as they are now. And we opened lower on Monday and then rallied back to Friday's low and took it out. And of those 9 occurrences, 7 of them were winners, and the average profit per trade was $1,000, which is real large. So I'm not disturbed to be a buyer of the S&Ps Monday. And my specific trade then would be if we open lower than Friday's low on Monday and then rally back above Friday's low, I'll be a buyer at Friday's low, maybe plus a tick, because I've taught oops to so many people now. I'm afraid everybody's going to have their buy point there, so I might, in my own personal account, fancy dance around a little bit in there. But that's the buy signal one of the buy signals that I'm looking for on Monday. Any questions on this particular oops pattern that I've explained? George?
Yeah, Larry, you talked about the S&P closing near the low today, and we just finished the section where you were talking about that indicates in your sentiment index that we're probably way oversold and should go up.
Right. And we have an oops pattern occurring.
For a lower opening on Monday.
Right. What I'd like to see, the sentiment indexes are going to be oversold in here. So we're saying, like my daughter said, when it's low, Dad, you should be a buyer. So the sentiment's low, we should be looking to be a buyer. Hopefully, we'll open a little bit lower on Monday, and then we blast off in the other direction. So it's kind of set up. The sentiment index is there. The oops trade may occur, and if it does, this would be one of my entries for Monday. Now, there happens to be another entry for Monday as well, which is really interesting. This is off the point of what I'm getting into, but the first Monday of every quarter of the year tends to be a rally time period in the S&Ps. And you computer whiz kid's going to go do all the stuff you want to, and then you say, whoa, yeah, that's really impressive. Again, the first Monday of at the start of every quarter tends to be very good days in the marketplace. So now I got a couple things nesting in together here, and I've got to be, I'll be awake early Monday morning and ready to trade the S&Ps, because I know I've got, not only do I have the first of the quarter, I've got an oops formation, and I've got my sentiment index in an oversold, if you will, oversold or too many sellers in the marketplace. So my trade Monday is I've got to be looking to be buying the S&Ps. Question here? I don't recall. The question for those at home watching the video is if the bonds are in sync with the S&P, how good was the signal? I'll tell you what we can do is on the break this afternoon again, I'll rerun it for us and we can take a look at it and see. But it's pretty impressive. Oh, yeah. 90% accurate.
What would you do if the bond...
Wait, hold on. He just wrote 90% accurate. Right, you heard that correctly. It's somewhere in that area.
You said it was $1,000.
Well, instead of giving me general numbers, it only takes a little bit of time to do this. So we'll run it and I'll give you specific, but it's about 90% accurate. I'm sorry, now your question?
What would you do if on Monday the bonds were down significantly?
I'd still buy. I mean, I know I've got my first of the quarter. I know I've got a formation I like. I know I'm oversold in the market. See, the neat thing about the oops is this. This is the way oops works in my mind. Everybody over the weekend that didn't come to this seminar is going to open up their Barron's or their Investors Business Daily, and they're going to see all this negative stuff. The Dow Jones Industrial Average is down again. And, I mean, you know what the public's thinking right now. The sentiment index is below 40%. So they're all bearish. They all want to be short sellers now because that's how people have been making money recently. So they figure that's probably going to continue. So on Monday, what the longs do, the weak-long hands, excuse the expression, they just puke it up. They call the broker and they say, sell it at the market. And sure enough, that's why you got the down opening. Then the market starts to come around and the broker calls them back and says, geez, we're rallying now. And they say, oops, I did the wrong thing. Okay, that's where it's to get this name from. So hopefully everybody will read over the weekend how bad things are, and the Democrats are going to lose to Republicans, and whatever is going to happen. Hillary's going to start trading commodities again to pay off the deficit. I don't know what will take place. Can you imagine this? Some of you have known me a long time. This guy on the radio, Rush Limbaugh, he's pretty good, but he's like awfully liberal. So that's my political perspective, okay? 3 weeks ago, I was at a cocktail party with Hillary. And it was really interesting. My friend says, Larry, this is Hillary. Yeah, do I ask her about commodities or not? I mean, you got to go for it, right? She doesn't like to talk about commodities, incidentally, I found out. Not at all. Okay. Back to work here. So the oops that I want to be a seller of would be on a Friday. If I open higher than a Thursday's high, if this was Thursday, then that would be my oops I want to be a seller of. If this day were a Thursday and I want to be a seller on a Friday, because I know there really is a distinct advantage to being a buyer on a Monday and a seller on a Friday. If you don't learn anything else, you'll walk out this room and leave this seminar and you're going to be doing anything on the stock market, you should consider that Mondays, Tuesdays are usually the days you want to be a buyer, and Thursdays, Fridays are usually the days you want to be a seller. It's not always that way, but like my daddy said when I left home, he said the race may not always go to the biggest and the toughest guy, but that's how you bet them. And indeed, that's the way you bet this game. That's one of the insight advantages that you can have, is just working the day of the week phenomena. And then you can build all kinds of other little things on top of that. Yes?
You do this after
after you identify that you're in that sentiment, an extreme sentiment, and then look for these food scenarios, or is this any?
Well, I've never asked, let me reiterate the question. The question is, would you take these, have you looked at doing these when the sentiment is in the buy zone, if you will? And no, you could run that real easily through TradeStation or SystemRite or any of these software programs and see. I mean, I know that this is so strong on Monday anyway. Even if the bonds are down, you want to do it. And I'm going to get into how significant it is when the bonds are up or down to trade the S&Ps, that you'll see that this is on its own. It stands on its own two legs real well here.
Okay, I wasn't sure if you're just swinging to the sentiment before we do.
Well, you could do that, yeah. George.
Is the first trading day of the quarter strong enough, and being a Monday and et cetera, that if it opens up on Monday, you can buy it on the opening?
Oh, George, you always ask the right questions. Yeah, I'll tell you this. I did my hotline stuff just before coming in the room, and I noticed that this first day of the quarter on a Monday, it's pretty powerful. I actually will be buying, regardless of the direction of the opening, 40 ticks above the opening, 40 points above the opening on Monday in the S&P. In other words, it doesn't have to rally much at all, and I want to be long, and that's based on buying on that first Monday of the quarter. 40 points. Yeah. That's what, 8 ticks? Yeah. 40 ticks is a little too much. Well, okay, I've digressed a little bit here, but it's been a lot of fun. Let's get back to being on some sort of schedule here. Okay, let's talk more about trading bonds and the S&Ps. One of the things I was criticized for, I gave a seminar a couple of years ago and taught people a lot about buying the market. And well, I want to know about the sell side of the market too. Well, he taught us a bunch of buy signals, so I'm going to give you some sell signals today as well. And you probably got it figured out now. When do you think we want to sell the S&Ps? Well, right, and when maybe the bonds have been doing what? Going down, right? You want this drain on the financial markets. You want the bonds to be going down. I mean, isn't it great to be a commodity trader? I mean, we're the only people that get off on feasts, famines, and disasters. I mean, I want sharply higher interest rates because it's going to drive the commodity markets wild. I'd love to see a 21% prime rate again. And I go to bed at night, please get Jimmy Carter back in office. I was so glad to see him go down to Haiti. I thought it was the most encouraging news I've seen since the 80s. Oh, come on, Jimmy. So I want the bonds to be in a sharp down move, and how are we going to define that? Well, we're real simple, and I'll write down some numbers for you here. And there's probably things you can do that are a lot more sophisticated than what I'm going to give you here. We're going to use the bonds, a 9-day moving average is less today than yesterday. Less today than yesterday. That's my filter. So the moving average of the bond is coming like this. Here's today's. And if it's down today, lower than it was yesterday, I'm then going to say, okay, I'm going to take a sell. Usually, of course, it will have been coming down something like this. Each day is lower and lower, telling the bonds are in a downtrend. And when the bonds are in a downtrend, we can do some pretty decent selling. I'll give you some small examples here. Remember that oops thing that I told you about, how to do an oops sell signal? Here's the oops sell signals only when the bonds are in a downtrend. Only when bonds are in a downtrend. On Tuesday, there have been 12 winning trades out of 14. The average profit per trade was $396. On Thursday, there have been 13 trades, 13 winners out of 16. Average profit $450. And on Friday, there have been 7 trades, 8 of those, 7 winners, and the average profit $515. So, and those are pretty decent numbers. This is basically getting in today and going to get out on the close. Those are high average profit per trade for the S&Ps. You look at most S&P systems, the average profit is like $150, $200. Well, these are pretty good numbers for short-term trade. So, again, what this is an oops phenomena when the bonds are in a downtrend. Something like that, yeah. So this is the problem with this is it doesn't trade a lot, right? Of course, you got to think the bonds haven't been in a lot of big downtrends either since 1982. But when they are, you know which side of the market you want to work. You want to be thinking about being the short seller. Well, I'd like to give you more trades than just these few trades, so I'm going to give you some other things with the bonds. Again, we have the same thing. Bonds are going to be in a downtrend now, and we want to be. Yeah, this is a real simple one. If the close is greater than yesterday's high, for you system writer people, this is what I call extension. So the market's going to have done something like this. There's yesterday's high, and we close greater than it. Real simple entry rule. We're going to sell at this low tomorrow. There's our sell signal, right? So the market may open here, it might open it might open any place. It might even open below here. If so, we'd sell it right on the opening. There have been 21 winning trades out of 28, 75% winners, and the average profit almost $400. Now that's really interesting because if you drop this bond thing out of there, you see that it's not nearly as successful. That your average profit drops, your accuracy drops. Question?
You're selling, but at what point?
You're going to sell at this day's low. Okay? So let's say this day's low is 462.30, and the bonds are in a downtrend. We've got bonds coming down here now in the moving average trend, and we have a day that closes greater than the previous high. We're going to sell at this low, and that gave us the 75% winners.
You're mixing S&P and bonds when you're talking about.
I'm sorry?
You're saying when the bonds are down and the S&P is showing above that.
Right.
Yeah.
See, the S&Ps are rallying against the trend of the bond. Means it's a suspect rally. And if they take out this low tomorrow, I want to be a seller.
Okay, so you put a sell stop order on?
A sell stop. Mm-hmm.
And then when would you exit that? At the end of the day?
Well, you can get out in the end of the day, that day if you want to. You can get out at a target. The exit's something else. You can go wherever you want to get out, but you can get out the next day sometime. But it's a real good formation to sell from. Let me give you another one. If the close today is greater than yesterday's close, and yesterday's close is greater than previous close, you can be a seller when the bonds again are the downtrend. So what this really is you get an up close and another up close. You get two consecutive up closes. You can be a seller in the S&Ps. In the case of, I just brought Wednesday, it's 15 out of 16, it's 93%. Average profit $1,003. Made $16,050. I'm going to leave this on the screen a little bit because I know some of you are writing this down. And also Friday. Remember we had a big Friday, I think a week ago. The market came down real heavily on Friday. You know why that happened in my mind? You had Wednesday up and Thursday up. You had two consecutive up closes, and the bonds were in that steep downtrend. Boom! On Friday, the S&Ps got hit real hard. Now we know why. That was a trade I took. So I'm looking for some divergence between the bond market, the trend of the bond market, and the S&Ps itself to do my selling. See, I've got this thing in my mind that we probably are in some type of a bear market. And I don't want to be doing the wrong thing either in whatever this bear market is. So I want something to really assure me that my sell signals are going to be valid. And some of you know, how many of you have System Writer here and have done any work on the S&Ps and stuff? Have you tried to get sell signals in the S&Ps? It's real tough. It's real hard to get sell, especially with numbers like this. But as soon as you put the bonds in as a filter, it's like the key just turned and the tumblers will click together and you'll see.
Very profitable system.
Pardon?
A very profitable system is if you buy only.
If you buy?
Buy only.
Yeah, if you buy only, right. Because the S&Ps have been this big uptrend, it's real hard to find any sell signals. And I beat my head to death trying to find sell signals until finally, dumb me says, hey, how about using the bond market, right? And then it's just sort of, there it is, right there. The bond market will show you a lot of stuff about the S&Ps. There's a question here.
Yeah, that 9-day moving average you do on the bonds, right?
Mm-hmm.
And this you do on the S&Ps, but when the bonds are in a downtrend.
Right. I'm going to trade the S&Ps, and I'll feel better about selling them short if I know the financial markets are undergoing some real pressure, i.e. the bonds are in a downtrend.
But you do your calculations on the S&P.
Right, but I do my calculations on the S&P, where I'm going to do my...
9-day moving average calculations are done on the bonds.
On the bonds. And so it's just, bonds are in a downtrend, now I can sell on such and such and such.
Are you still waiting for yesterday's low as a trigger?
In this instance, let's see what we were doing here. Yeah, that was selling, again, selling this day's low, which is not a very complicated entry technique. I mean, you could get a lot better entry techniques on this, but it would probably give more trades even if you sold higher, because you've got to give back all of yesterday's low. So you can increase your number of trades, and but I just want to show some basic entry techniques. That's a pretty good little pattern. This is not on days of the week. This is all days of the week, and this is one is just on Wednesdays. And I would point out, so you're going to sell on Thursday, right? This I'm going to do on Thursday, and you also want to, yeah, that's probably the best. Wednesdays and Thursdays. Wednesdays and Thursdays. You don't want to no, that's not clear to you. Let me do this. You're going to take action on a Thursday, or take action on a Friday for 2 consecutive up closes. The best one is Wednesday and Thursday are up closes, then you can be a seller on Friday. I had at one point, before this thing happened 2 weeks ago, I think all my entry rows just sell on the opening on Friday. And so we sold real early in the day on that day. And simply because 2 up closes and the bonds are coming down, stocks are going to probably get back in phase with the bonds. And it doesn't always happen, but certainly it usually does take place. Any questions on that? Well, again, we haven't seen a lot of trades here, but I'm going to show you one now that has 2 more trades for you. I'm sorry? 30 minutes. Oh, gosh. Okay. Thank you. Do I have a book that covers this? No. Stuff's too good to put in a book. Okay. We're not going to get through everything. If today's close is greater than the close X days ago, and bonds are down, there's some real good Wednesday and Thursday sell signals. Good in one instance because they have a lot of trades. If today's, I'm going to put is, this is X, $15,100, 25 out of 30 trades, average profit $503. If X is 2, it's 32 trades out of 39, 32, 39, average profit about $400. On Thursday, we're going to take action now on Thursday. On day 1, is X is 17,525, 24 trades, 1 out of 31, $565. 2, $31,950, 33 winners out of 39, $819, and 3, 17,575, 30 winners out of 37, average profit $475. So what I'm saying is if the S&Ps are greater than the close 2 days ago, in other words, they bounce and they come up a little bit, but the bonds are still in a downtrend, then I'm going to sell, I'm selling at, I think I said in this example, sold at the low again, just like we talked about earlier. You're going to sell there, and those are the approximate numbers you're going to produce. So we know we can work on Wednesdays and Thursdays to be a seller if the bonds are in the downtrend and the S&Ps have come up a little bit. Now notice this doesn't limit itself to exclusively 2 consecutive up closes. You may have a big down close, a small down close, and then an up close that's greater than the close 2 days ago, so you're kind of weak in the market. Really, you just had one up day. But it's a relationship I found. The important thing is the relationship of the closes a couple of days ago. That's the important relationship. And when you get that little overbought little bubble in the market, a little popcorn rally, and the bonds are in a downtrend, you get that type of trading. These are awfully good numbers for sells in the S&Ps. $819 a trade. And I did check. One of the things I always like to look at is, let's say on this $31,000 profit, you had one trade was, there was a day in 1987 in October, the market came down. Remember that? Well, maybe made $20,000 on that one day. If you take that out, then this number doesn't hold up. But none of these had those $8,000 or $9,000 highest average or greatest profit. These are, the average profit and the largest profitable trade. You just take it out, and they still held up real well. Any questions on what I've gone over there? A couple here.
Do you have much problems with slippage?
Do I have much problem with slippage? You guys get slippage? Yeah, of course I have problems with slippage.
How much did you take into it?
I've only taken in $50 for slippage and commission. And that might be a little low, might be a little high. Sometimes I actually get positive slippage. It depends on your commission rate. $75 might be more realistic for most of you. $50 is maybe a little too much of a skin flint on my side of the equation, but I have deducted for it. And all this data goes back to 1982 through June 1993. Is there another question there?
Yeah, in all the work that you've done, back-testing systems and such, have you found there's been degradation in performance over the last year or two when you look at them, say, over the last 15, 20 years?
Let me see if I understand the question correctly. Have I found that there's been poor performance in the systems recently?
Right. The systems aren't working as well. And I guess there's a corollary to this. On, say, for instance, that first one where you have 25 out of 30 that were working, might 7 of those, of the 7 that weren't working, were they more recent? You know what I'm talking about?
Yeah. The question is, did you make all the money 5 years ago, and who cares about 5 years ago? We only care about today, right? Because we're Americans. How good is your last trade, if you will? And the answer to that is, that's another scan that I take through when I look at the trade-by-trade recaps to see, and no, that doesn't exist in any of these. And my sense is, because I've been trading the markets for a few years, that's always been important. If the bonds are down, I mean, boy, you got a loaded deal there. So in this particular stuff, I wouldn't worry about that at all. Now, some other system, it might be different. But I mean, one of the first lessons I learned in the market is stocks follow bonds. Go where the money is.
Larry, what about
systems in general? Well, I think systems in general are come in and out, almost like spads. They come in style and out of style. Good systems still continue to hold up relatively well. But what's happened is we've all optimized systems so they look real good for a time period, and then people trade them and they don't do real well for a time period, and then maybe they get good again for a time period. Part of the problem is what I talked about at lunch today. Everybody has this idea that you just buy a system, you're going to own the world, and 6 months later, it doesn't happen. The performance is never as good as the system. Some things have held up real well. How many of you have learned my oops before? Could you raise your hands? My oops trade. There's only a couple of you have learned. Have any of you have traded the oops trade? Have you watched the oops trade? And do they hold up still? Yeah. I mean, there are some things that are real generic to the market that's just real tough to find them. To get the truths of the market, what happens with computers, we get things that look like truths of the market, and we find out later that they weren't. That's been my experience. Question over here.
We talked about a lot about how we determine when to sell, etc. But I'm still confused as to how we know when to get out. That's invariably a trigger where they sit there saying, okay, I'm in and I'm making money now, when do I get out?
Well, I'll tell you how to get out. The best way to get out is what I call the calculator rule. It goes like this. As soon as you look at the profits and you say, oh, let's see, that's $500 a cent, and I've got 3 contracts, and you start to put that in your calculator, call your broker and get out. That's the best rule I can give you about getting out of the market. As soon as you say, oh, I just made a bunch of money, the market's going to move the other way. You can get out on the close. Most of these numbers I'm showing you are similar to getting out on the close, okay, with a protective stop at $2,500. I have as you can see, I'm just giving away a lot of stuff. I don't have a lot of proprietary things, but my exit technique is somewhat proprietary. And for those of you who know bailout, I got a whole new one that's a whole lot better because it takes our risk-reward ratio up to about 1.5 as opposed to 0.8 or 0.6. The accuracy drops from 85% to about 70%, but you can't get everything in life. Okay, let's see what we're going to talk about next. Any more questions on any of this yet? Yes, please. I'm sorry? No, percent R is just another one of those overbought, oversold indicators. The sentiment indicator really looks at the market differently than percent R does. First, it looks like they're doing the same, but you put them up on a chart and you'll see that clearly there's a huge difference between them. Okay, what are the little goodies that I bring out of the closet to have for you people in Los Angeles? Oh, yeah. Well, this is a good one. Let's do this one. How about buying? We've done all this sell side stuff. You guys still want to buy a little bit, right? Yeah, let's do some buying. This is the little goodie that I did a year ago. September, October, I taught this system. And this might be the one we talked about a little bit earlier. This has continued being real good. Notice I've got 85% of the trades were winners. It made $122,000, 213 trades, 182 winners, and the average profit per trade is $573. And again, I said that's important to take out the largest winning trade here of $6,000. You deduct that from $122,000, you still got all kinds of money. And again, this is after $50 slippage in commission. And all it is to buy the first and the last Monday of every month. And we're going to take 10% of the previous day's range, of Friday's range, add it to Monday's opening, and buy at that level. That's really kind of like the end of the quarter one that I just gave you, right? Because that end of the quarter is also going to be in there. But this is simply buying the first Monday of the month and the last Monday of the month. Is that right? The first and last Monday of every month. And we stop and think about it. That's a lot of money, $122,000 for just doing one simple thing. You got 2 trades a month, and that's all there is to it. But I know you people, you're just like me. You can't live with just 1 trade or 2 trades a month. You want to have 3 or 4 or 5 of them a day. And one of the best things you can do is to learn to just sit on your hands and not over trade. I was in a brokerage firm, I'll get your question in a minute. I was in a brokerage firm a couple of weeks ago. Saw some really interesting things. This young kid is in there, and he says, I got my first client. And he says to the manager of the office, he says, this guy's got $20,000. He says, what do you think I'll earn on the $20,000 if we keep this guy around for a year? And the manager says, well, you ought to make $15,000 in commissions. Anybody wonder why this is such a hard game to win at? And I thought he was being very kind. I mean, I know guys who say, hey, for every dollar, you've got to get $3 in commissions. The other side of this, though, I was in the same young kids in the brokerage firm. I heard this conversation he's having. It goes like this. He's calling up Mr. Jones in Peoria or someplace. He says, oh, Mr. Jones, I'm so-and-so with such and such a brokerage firm. And I notice you have an interest in trading commodities. Are you trading? The guy says, yep, I'm trading. And he says, well, and how are you doing? And, of course, I just hear one side of the conversation. It goes like this. Oh, so you've been losing. And how long have you been losing? About 6 months. Well, Mr. Jones, would you be interested in perhaps trading another program? Nope. Oh, you want to continue trading what you've been doing? Yep. That's kind of strange, isn't it? Here's the guy, whether the young broker has got a system or not, this guy is real content to continue losing his money. Amazing how people work. Are we clear on what we want to do on this first Monday, last Monday of every month? Question there. Thank you.
Have you tried the influence of the bond market on this?
This is, oh no, all you see, this is just what's on the sheet of paper. That's all there is to this.
But have you tested
There's no bond, no, I haven't tested the bond market with it. You could do that. If you want to, we can go back and plug that in and see what it does. With 85% accuracy and $503 a trade, pretty good numbers.
So you're saying on this, you buy and then you sell the next day?
Yeah, I'm going to get out with it. $500 profit, or whatever, however you want to get out. I'm not going to give you everything I got, okay, guys? Come on. But I'm going to get out at the end of the close, the same day of entry, or I'm going to take a profit in the next day or so. I don't hang around. Notice my average length of trade is, let's see, average bars is 1 day. I'm in the trade for 1 day. Some people like these systems where you're in a trade for 35 or 40 days. For Pete's sake, Here in California, they don't put people in jail for murder for 35 days. They don't. I mean, think about this. The jury for O.J. is going to be sequestered for a longer time than he'll probably serve. Amazing. Oh, only in America, right? So I'm not hanging around long. I'm a short-term trader. Okay, well, let's go look at a couple other things, some buy signals we can look at here. Interest rates in bonds? Well, I thought he did. Oh, you mean interest rates and currencies? That'll be another seminar. Yeah, you can do things like this for bonds, but I mean for currencies, but that's another time, another place. Unfortunately, we could go forever doing this stuff. There's so many things to talk about. Okay, here's a real simple system for you. Again, I'll preview the numbers. This had made $60,000. The average profit is $467, 82% accuracy. So it trades quite a bit, 128 times. And the rules are pretty simple. On any day of the week except Thursday, because remember, I don't want to be a buyer on Fridays. I'm a little suspect about being a buyer on Friday, okay? If the close is lower than the previous low, and the close of that day is also lower than the low of the day before that, in other words, I've got a close here that's lower than here, and this close is lower than here, then I'm going to buy at this day's low. I'm going to buy at this day's low. I'm going to buy at this day's low. If the market comes back here, I'll be a buyer there. I get two of those extended days, boom, boom, like that. And if I open lower than this day's low, I can't open up here. I've got to open lower than this, and I'll start to move up, and I want to be a buyer there. And that's what produces these results. As a matter of fact, I'm going to illustrate this a little bit more for you because I have found that the markets, this is really how the markets bottom so frequently. The markets will come down like this, and this is all that we have. The market's been coming down in a downtrend. And one of the better buy signals, and you can look at this in your charts, and maybe somebody who's more sophisticated and intelligent than I am can put this one together. I've got parts of the pieces of it, but it's this, is if you open lower than this day's low and trade up to it, you probably have made this what I call a ringed low, and you're going to have at least a short-term rally in the market. You'll be amazed at how many times, if you look at your charts, that you'll see this opening in here lower than this day's low, and that day's low is a great buy signal. If you've been coming down, trying to find a short-term ringed low or a short-term swing point in the market, those of you call these swing points, seems to be the way the market bottoms. What you've got to be suspect of, if the market comes down like this, and it opens greater than this day's low, lots of the times this really will continue coming down and you get a new low. This doesn't seem to be the way the markets will really bottom. For a good solid bottom, they seem to do it like this. If you really look at your charts, you'll find that that phenomenon is taking place, opening lower than there and your buy is coming in there. Any questions? Yeah, please.
Do any of these patterns correlate with the candlestick patterns?
I don't know. I was really worried today. At lunch, we had chopsticks to eat with, and I thought, oh my gosh, this must be sponsored by the candlestick people. I don't know much about candlesticks, but you know what I want to do? I want to go to Japan with a book called Light Bulb Charting and inflict them with what they've inflicted upon us. I happen to have a notion that candlestick charting is just, it's another, I hate to say it, but gimmick. I mean, it's not a system, it's a tool, and I don't know if it is or not. I did a lot of tests with candlestick patterns, and I couldn't make them make money. There's one book that's been written by a guy in Texas that's pretty good that goes through all kinds of candlestick patterns, and hardly any of them make any money. They're not quite what they've been billed to be, in my opinion. Though, they're very popular because there's, a lot of stuff to look at, and people love to have a lot of stuff to look at. And you know me, I want hardly anything to look at. I got open, high, low, close. And that gets me real confused with those four things. And you start to put all this other stuff in there. Not only in my own looking at the chart, but when I ran it in the computers, I couldn't put a lot together with candlesticks, and maybe that's just my inadequacies, and maybe candlesticks are the greatest thing in the world. I just couldn't figure out how to use them. Okay, so that's the way markets seem to top and bottom, and hopefully somebody can do something with that and write me a letter sometime about it if you would. Okay, we've got 7 minutes left, and we've got a couple more things to go over. So let's do it. Maybe we'll have one more thing to go over. I'll give you another one as well. Option expiration, yeah. Oh, gee, this is a great one. If we get in a bear market, I think you're going to continue seeing this trade be very effective. Let me also add, I want you to really remember this as a distinct point of this event, and it's that you cannot be just a seller in a bear market. If we get into a bear market, you want to still be taking buy signals, and if we get in a rip-roaring bull market, you still want to be taking some sell signals. Because the most explosive moves of the bear market will be large 1 or 2 day rallies, short covering rallies. And the market will be coming down, have a huge rally, and then it just falls apart a couple days later. But those huge rally days are very, very profitable. Just as in the huge bull market from 82 to 90 to 87, there were some great short selling days of bear raids, collapse in the bull market for a couple of days, and then the market spins on a dime and goes off again. So don't think just because we're in a bear market, I can't do any selling. When I've tried trend filters on the S&P, i.e. the S&P's in a downtrend, don't take any buy signals, oh man, that's a disastrous way to trade. In fact, you want to be able to take buy signals in a downtrend because you get these huge explosive rallies. So just make certain that you don't, if we get in a bear market, that you don't just walk away from all the buy signals, because you're going to leave a lot of money real quick, 1 day, 2 day type things on the table, and I don't want you to do that. Well, here's the last thing we'll close with. This is option expiration. And I notice there's a real strong tendency for the market to rally around option expiration. The rules are real simple. We're going to buy on the close of the week prior to option expiration, and we'll exit on the first profitable opening. We're going to use a $2,750 stop. That's all there is to the trade. We're going to buy on the close of the Friday of the week prior to option expiration. Place your stop. First time you got an opening that's got a profit, you're going to get out of it. That's it. 141 trades, 87% accuracy. Oh, but there's an error in this. I taught this a year ago. There have been 12 months since this was taught. So now we have 12 more winning trades. Every single one of them has been a winning trade this year since last October. Hasn't been a loser in the lot. And we've been in a really kind of choppy, weird S&P market. It's gone up, it's gone down, it's done everything, but the option expiration phenomenon has continued to be profitable. So this is one you might want to make some quick notes of and write it down and be thinking about it, because we'll have an option expiration coming up in October and in November and in December and in January. And you don't have to use just my little thing, buy it on the Friday. You might want to try to finesse this in your own in some fashion, see what you can come up with, and hopefully you can make it even better than what I've done. The average profit's $385. It's not bad. Closeout drawdown's really small, $3,300. Well, you know, unfortunately I could go on forever. I need to stop now and see if there's any questions to kind of wrap this thing up. So if you have questions, fire them away. Yes?
What do you mean by first profitable opening?
The first time the market opens greater than where you bought it, get out. Question?
When you look at trade, do you take into account, or has that affect the Globex trade in the morning?
I'm using just the day session ranges, and I'm using day session openings for the S&Ps and bonds for OOPS. I'm not using the overnight ranges. I don't know if that's right or wrong yet. We don't have enough data, but that's the way I'm doing it. Please.
Can you quickly talk about cash futures price of S&P?
Talk about gaps?
Cash price.
Cash to the S&Ps. Oh, boy, that's... one of the strong relationships, as I pointed out in my 1973 book, How I Made $1 Million Trading Commodities, is the relationship of cash to futures prices. They're real important. And lo and behold, 20 years later, it still exists in the S&Ps. One of the best tools for trading the S&Ps on a short-term basis is cash and future spread. When the spread gets strong, while the price is going down, you want to buy the S&Ps. When the S&Ps are rallying, and you get 3 or 4 consecutive lower lows in the 5-minute spread, you want to be looking for a sell. It's an oversimplification, but you know, this is we're real short on time. But no, it isn't. But at the seminars, the real-time trading seminars I do, that's where I tell a lot about, go beyond what I'm doing here. Any other questions over here? Y'all fall asleep over here, huh? Okay. Any other questions here? And how are we doing over there? Okay. Well, yes. I'm sorry? Yes, a lot about open interest. Open interest is really used to forecast longer moves than what I'm telling you about now. This is pretty much, 2-3 day trading, and open interest is going to reference you to trades that are going to last hopefully 10, 12 to 20 days. So it really isn't germane to this. This is, I think the title of this was Secrets of Short-Term Trading or something. That's what this is about. But it's important that you figure out what you want to be. Do you want to be a short-term trader, intermediate-term trader, long-term trader? So many people want to emulate me, or they want to emulate somebody else. You can't do that. You got to be you. And once you find out what time periods you're comfortable with, you'll start to be a lot better trader. Well, I hope that I've been able to provide you with a little bit of insight into the markets today that you haven't had, and maybe give something to you that you can take home and work with. That certainly has been my intentions. You've been just a great group, and I hope you've learned something, and I hope at some point I see you another time, and I wish each and every one of you nothing but good luck and good trading in the market. Thank you very much.